All right, episode 11 of the 11-part series of the hard landing and why I think we are entering a recession. This is the last video. This is preparation. This is how I'm preparing. I can't give any of you financial advice or I think really any advice, but I'm just showing you what I'm doing to prepare for this. Okay. So it's really three things. One is to build an emergency fund. This is especially in case you get let go. Everybody thinks, no, there's no way I get let go. Well, a lot of the times it's not up to you. It's not up to your boss. There's just, if people don't have the money to pay you, you're getting let go. Okay. So build up an emergency fund. Count your expenses for a month or two and just start building towards it. Put 25 bucks a week, 50 bucks a week into it so that you have that cushion. Okay. You'll feel a lot better when, you save up, just say right around $5,000 and you have that cushion just in case, right? You won't be freaking out, stressed out if that did happen to you. Okay. This is what I would say to myself. Okay. If I was giving advice. You might say, well, what about inflation? Isn't that cash just being eaten away? Well, you can put that in a money market mutual fund. This is the money market ETF. If you don't want to do a mutual fund, this is the mutual fund. ETFs are a little bit more flexible and you can get your money out like right away, whereas money market mutual fund, you have to wait like a day. But this invests in short-term treasuries. So I think it's right around 3-month treasury bills. And this rate of return is right underneath the Fed funds rate. And the Fed funds is 5.33 right now. So you can get like 5.2% yearly rate on your cash right now if you just invest in these money market mutual funds. And if the Fed funds rate goes down, to say drop to 3%, you don't lose money. Okay, you won't lose money. The rate that you get on your money will just go down. Okay, so instead of 5.2%, you might get 2.9%. Okay, but you're still getting a return. And the reason you don't lose money is because it turns over so quickly. It's like 1 to 3 month T-bills, so it turns over so quickly. It just takes your money and then invests in the next month as it goes. So I would say, really, if you ever have any cash, you want in a money market mutual fund at the minimum. Okay, especially now with these rates so high, it's essentially free money. Again, this is what I would tell myself. Number 2 would be to grow your self-value. And you can do this in multiple ways, but mainly just make yourself valuable at work, okay? Make yourself stand out. One big way to do this is to go into the office. Studies show that people that you see every day, you're way less likely to fire them or let them go. Just because, if someone works remotely and you don't see them every day, it's a lot and talk to them every day, it's a lot easier to just let them go. Whereas if you actually have a relationship with someone and their personality, you really don't want to let them go. So go into the office, grow your value, work hard, just don't slack off right now. Okay, this is not the time to be slacking off. Okay, long story short. And the last one I would tell myself would be to diversify and really de-risk your investments, because as I showed in the stock market video, that the S&P 500 is a third of the top 7 companies. A third of S&P 500 weighted is just 7 companies. So if the market crashes, you're gonna crash too. Okay, same with like your retirement fund. That's just invested in the market, and you're just gonna go with the waves. And if you're fine with that, fine. But I'm going to show what I'm doing to hedge against that. And basically the rest of this video is going to be about the last one, the investments. Okay, let's look at this chart that shows asset class performance around the business cycle. Okay, this is a really cool chart. So essentially, as rates rise, the value of the dollar typically rises because as rates rise, the currency rises too, because you get a better return on that currency, so people will buy bonds in that currency, et cetera, et cetera. Momentum stocks increase, so Nvidia, tech stocks, technology. Okay, and then once you start to turn that corner, this is where I think we are, and you start to enter this recession, what does well are consumer staples. I wouldn't say too well. I mean, they do better than the S&P 500. Why would that be? It's because people still need staples. They still need toilet paper. They still need groceries. These are the types of things people still buy during recessions. And what else also do well are long-term government bonds. And like I talked about this in the previous video, but as rates go down, which happens when a recession happens typically, the long-term bonds increase in value the most because they have the longest duration. Okay, so if I bought a 30-year bond at 5% and then they dropped to 3%, people would pay a lot of money for my 5% yearly bond, right? So the value increases. So those do quite well. And then, this is still really kind of part of the recession here. And you have staples again. And you also have gold here. Gold is really a hedge against uncertainty. I actually highlighted these exact four. So the T-bills, so the short-term bonds, which is the money market mutual funds like I was talking about, you can invest in these. These are essentially zero risk. You can't lose money. If you have cash, put it in here. Notes are greater than a year up to 10 years. And this right here, I am heavily invested in. This is TUA, and this is the 2-year bond, okay? But it's leveraged. I think it's like 5x leverage on the 2-year. So I believe I have a slide. Yeah. So I showed this slide in the yield curve video. But essentially, if the blue is the Fed funds and the orange is the 2-year. So if you notice, the 2-year always moves before the Fed funds, right? It always moves before and always drops before. It moves before. So if you just slide the 2-year to the right, it basically overlaps the Fed funds, right? So if you think a recession is coming and you think that they're going to drop rates to stimulate the economy and, make credit easy again, then what would you expect the 2-year to do? It would drop prior to that, right? And what did we say about short-term rates, or I guess rates with the duration closer to the Fed funds? They are very correlated, right? The 2-year is very correlated to the Fed funds, whereas the 10-year kind of has a mind of its own, right? It's correlated somewhat, but there's a lot of different factors that go into this. You have geopolitical risk that could affect this, because this is people's thoughts over 10 years, whereas this is just people's thoughts over 2 years. So if you think the 2-year rates are going to drop with the Fed funds, then this TUA basically increases in value as the 2-year drops. And then The last one are bonds. This is 20-year duration and greater, and that would be this purple one. And like I said, this kind of has a mind of its own, but if these both drop sharply, I mean, you could probably expect the purple to drop as well if you just look at this pattern. Ooh. So if you just look at this pattern, I mean, it kind of, pretty much it goes line in line with it. And this will probably give you your best return because of what we just said. The longer the duration, the greater the return. And I should clarify, this purple is the 10-year, but it's very, very similar to the 20-year and the 30-year. So it's a good representation of it. So if you want to hedge with bonds, these are really the two, the TUA and the TLT. And if you want to just get a free rate, put it in a money market mutual fund, this is the Schwab one. Again, this is what I would tell myself. Okay, consumer staples, that's XLP. I haven't done too much research on this, but I can tell you it'll probably do better than the S&P 500. This is the consumer staples part of the S&P 500. So you're still investing in the top companies that are in the top 500. Okay, gold. If you don't want to actually buy physical gold, you can invest in the ETF, GLD. And again, gold tends to do well after a recession because it's a hedge against uncertainty, really. Okay, so as the dollar decreases in value, gold goes up. When there's geopolitical risk, gold goes up typically. And I'll show a chart here in a second that shows that. And if you want to invest in Japan, kind of piggybacking on this catalyst video I talked about, where you might see that reverse carry trade and Japan stocks really do well. This is the Japan stock market, and I'm invested a little bit in there. So yeah, those are really the main hedges that I'm in, and I really like these bonds because I really think rates are going to drop. I think they're going to drop harder and faster than at least the public is anticipating. It may not happen till 2025, but just know that you kind of pay a premium to hold these, especially TUA, because it's leverage. So you lose a little bit, but when it pays off, it pays off. So it's kind of like insurance. So I mean, those are basically what I'm hedged with. Now, I want to be very cautious on the TLT, because remember how I said it has a mind of its own? Well, it's also starting a new cycle of the long-term debt cycle. This whole series is on the business cycle, and that's the short-term debt cycle. But if you look at the long-term debt cycle, this is it in reverse, essentially. This is the 10-year bond, okay? And I think this is 1982, it started coming down, and it has been coming down. And COVID was kind of the bottom out, and we are now on the rise again, okay? This is you're looking at the long-term debt cycle here, okay? World War II was the other bottom out. COVID's this bottom out. So when you hear people say, higher for longer, this is what they mean, right? You could expect these to go up, down, up, down, up. I mean, that's what people think is going to happen. And if you were to bet on the TLT, you'd really be betting on this play, right? This drop, maybe from here to here. And, it's more than you think. It could be 20%, 30%, I don't know. But be careful, because this is likely to start shooting back up, because this is kind of what happens in these cycles. I'll go way more in depth on this in a future series on the long-term debt cycle. But just beware that the bonds are going to be tough to time. But if you get in, now and can time it prior to the rates dropping, you might be able to make a little bit of money. And there's in my mind, I think that there's very little risk that they raise rates from here, right? I mean, what are the odds they raise rates again? So minuscule. So you're really betting on the rates to go down. You're paying a little bit of a premium, but the odds of them going right up are so minimal, right? So my risk return is very it's low risk, high return essentially. Okay, and this one more chart is kind of showing what those assets I was looking at. So this is recession and the days around the recession. So I believe this is after and this is before it. So everything kind of goes down in the recession and prior to it. But after the recession, look at gold. Okay? I mean, look at gold. It just outperforms all of these by a ton. So if you're going to buy it here, or I guess maybe buy it here, look at the potential. Okay? And why risk missing this? And I will say that you don't go on the news one day and they say the recession starts today. It's always, hey, we've been in a recession for 2 months, or we've already been in a recession for this long. It's because all the data is always delayed, right? It always comes in late, and no one actually knows for months and months later until that they know that they're in a recession. So that's basically what I'm saying. Like, who knows? We could be entering this even quicker than I'm saying. Like, who knows? We could be in a recession now. Who's to say? This is U.S. Treasuries, kind of those bonds I was just talking about. Those perform decent. And then if you look at the S&P 500, it goes down. And this is just looking back to 1973. So, I mean, just look at this. If you think we're going into recession, are you going to invest in the S&P 500 or are you going to invest in treasuries and gold? I know what I'm doing. That's that. That's the end of my series. If you liked it, please subscribe. I appreciate you if you sat through all these and listened to me talk. But that's my base case. That's my thesis. And I'm hoping that I gave anyone watching this value. And, I don't want the economy to hurt. And I don't want a recession, but it's inevitable. And I'd like to at least be prepared for it and hedge against it. So, if you want to follow along, one additional preparation would be to stay informed, and hopefully I can keep you informed on what's going on. I'm planning on making videos quite frequently, so please subscribe. Until next time, Godspeed.